Welcome to Capital Conversations. Today, we're tackling a decision every founder faces. Do you build a relationship with a traditional bank or move fast with a fintech? I want to start with a quick vignette. Two similarly sized businesses, both profitable, both growing. One went to a community bank for a line of credit and a term loan. The other used a fintech to bridge seasonal payroll and scale fast. 6 months later, one had lower interest cost, but slower draw timelines and more covenant work. The other secured cash in days, but paid higher fees and had tighter payment pools. By the end of this episode, you'll have a clear framework to decide which path fits your business, plus scripts to shorten approvals and protect ownership.
Joining me are two guests who sit on different sides of that decision. Maria Santos is a commercial lender at Riverstone Regional Bank. Maria, welcome. Tell listeners what kinds of deals you underwrite and a common borrower mistake you see.
Thanks, Glenn. At Riverstone, I work mostly with small to mid-market businesses, manufacturing, construction, and some healthcare practices. Typical credits include asset-backed term loans, equipment financing, and ABL-style lines for seasonal working capital. A common mistake I see, borrowers assume the bank will accept minimal documentation because they've been in business for years. We still need clear cash flow statements, updated tax returns, and ownership history. Surprises in the books slow approvals significantly.
Great context. Ethan Park is Director of Small Business Capital at Orbit Capital, a fintech that provides working capital lines and quick-term loans. Ethan, what's your typical borrower and the most frequent misstep you see on applications?
Thanks, Glenn. We tend to fund online retail, services, and gig economy businesses, companies with digital payment flows or predictable receivables. Our key differentiator is speed. We use API-driven data and automated underwriting to approve in hours or days. The misstep is expecting fintech terms to be identical to bank loans. Fees, holdbacks, and repayment triggers can be very different, and founders sometimes underestimate the cash flow impact.
Section 1. Underwriting Fundamentals. Maria, at a high level, what does a bank actually evaluate when you underwrite a small business loan?
We look at 5 core areas: personal and business credit history, verified cash flow, usually bank statements and tax returns, collateral and its value, industry and management experience, and legal documentation, including contracts or purchase orders if applicable. For term loans, we want historical EBITDA or SDE. For lines, we focus on cash conversion cycles. The practical checklist we ask for: 2 years of business tax returns, 3 months of bank statements, descriptions of major customers, and a cap table if there's outside equity.
Ethan, how does the fintech underwriting checklist differ in practice?
2 main differences: the data sources and tolerance for non-traditional metrics. We ingest payment processor data, accounting software, and bank feeds to model day-to-day cash flows. That allows us to fund businesses with shorter histories or lumpy revenue, as long as the revenue is trackable. We still evaluate credit and the business's unit economics, but we weigh recurring payment patterns and gross margin closely. Documentation is lighter. Often 3 months of transactional data can be enough, but the trade-off is pricing and stricter automated repayment mechanics. So, to summarize underwriting, banks prioritize stability and documented earnings, while fintechs accept modern data in exchange for tighter payment enforcement. Let's move to costs, speed, and structure.
Maria, walk us through base costs and structural terms a founder should expect at a regional bank. Interest, fees, amortization, covenants.
Banks typically price loans based on a spread over a benchmark, prime or SOFR, so you'll see variable rates that can be competitive. Fees are usually origination and due diligence costs, often modest for repeat customers. Amortization can be longer for term loans. Lines may have interest-only periods. Covenants vary. For new credits, expect cash flow covenants like a minimum DSCR, limits on additional indebtedness, and periodic financial reporting. Prepayment may be allowed with minimal penalties on smaller loans, but negotiated on larger facilities. Banks often offer flexibility in exchange for long-term relationship value.
Ethan, how do fintech costs and structures compare, especially when founders need speed?
Fintechs trade speed and accessibility for higher effective costs. You'll often see higher interest or factor rates, platform fees, and sometimes daily or weekly repayments tied to daily sales. Products like merchant cash advances have predictable but front-loaded costs. On the upside, approvals come quickly, and the application burden is lower. Some fintechs offer hybrid products, short-term, higher-cost funding to bridge until a lower-cost bank facility is in place.
Section 3. Which partner when, and practical negotiation scripts. Let's build a decision framework. Maria, when should a founder favor a bank?
Choose a bank when you have documented revenue and want the lowest long-term cost, need larger ticket sizes tied to assets, or want covenant flexibility through relationship banking. Also choose a bank if protecting ownership is a priority. Banks don't take equity. If you can wait for a thorough underwriting process and want predictable amortization, a bank is usually the better long-term partner.
Ethan, and when is a fintech the better match? Go fintech when speed matters, documentation is digital and verifiable, or you need bridge capital to capture time-sensitive growth. Fintechs are also a fit when you lack long tax history but have solid transactional data. If you're willing to accept higher cost for immediate liquidity and automated repayment tied to revenue, fintechs can be the smarter short-term choice. 2 short scripts founders can use. For banks, we have 3 years of tax returns and detailed cash flow projections. We're seeking a $200,000 line to manage seasonality and can provide monthly reporting. If approved, we'd like to discuss a stepped covenant structure tied to growth milestones. For fintechs, we can connect our payment processor and accounting feed today and need $75,000 in working capital within 5 business days. We understand repayment will be tied to daily sales. Please outline fees and holdbacks up front. Use these to get precise answers and timeframes.
Now, 2 real borrower case studies. Maria, can you give a quick example where a bank relationship paid off?
Sure. A mid-size fabrication shop approached us to finance a $500,000 piece of equipment. They had 5 years of tax history and solid backlog. We structured a 5-year term loan secured by the equipment with a seasonal line for inventory. Our pricing was lower than alternative lenders, and because we built in seasonal covenants tied to AR aging, the business avoided diluting ownership and had predictable payments aligned to cash flow.
Ethan, a fintech success story? A direct-to-consumer brand with rapidly scaling online sales needed $120,000 to fund inventory before a major promotion. They connected their processor and accounting feed, we approved within 48 hours, and funded in 3 days. The brand accepted a higher fee, but captured a sale event that tripled their monthly revenue. They later refinanced with a bank for cheaper, longer-term capital once their revenue stabilized.
Practical steps listeners can take this week. 1. Assemble a 1-page financial snapshot. Revenue last 12 months, monthly burn, top 3 customers, and runway. 2. Pull 3 months of bank statements and connect payment processor logs. 3. Prepare a short ask script with amount, use of funds, and desired timing. 4. Contact both a local bank and a fintech to compare written terms. Don't rely on verbal quotes alone. Before we close, 1-line recommendations. Maria?
If you can wait and want lower long-term cost while protecting ownership, build a bank relationship early and bring complete documentation to shorten approval time.
Ethan?
Use fintech capital to move fast and scale aggressively, but plan to refinance to lower cost debt once your revenue becomes predictable.
Recap. Match your business profile to the partner. Banks for documented, asset-backed, lower-cost relationships. Fintechs for speed, digital data, and short-term growth needs. Prepare the checklist, use the scripts we shared, and always get written terms. If this episode helped, subscribe for more funding playbooks and frameworks that put you in control. Keep building. Let's talk capital.
Thank you for joining us on Capital Conversations. I hope today's discussion provided valuable insights for your funding journey. Remember, securing the right capital is a crucial step in building a successful business. Until our next conversation.